Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Institutional Portfolio Manager Abhijeet Singh joins the show today to take us through the current landscape of emerging markets around the world and to discuss the investment themes shaping Fidelity Emerging Markets Fund. Abhijeet points out that a potential U.S. rate cut could benefit emerging markets by alleviating pressures from a strong dollar and high U.S. rates, which have historically posed challenges. He highlights specific regions like Brazil and Mexico, where maintaining higher interest rates has helped stabilize currencies despite well-controlled inflation. He contrasts the investment appeal of countries like China, with attractive valuations amid economic stabilization efforts, against India, where high valuations have tempered investment enthusiasm. In terms of sectors, he favors materials and consumer sectors, but advises caution in tech due to inflated valuations. He highlights the benefits of a balanced growth at a reasonable price strategy, which positions the Fidelity Emerging Markets Fund to capitalize on diverse opportunities while managing risk and global uncertainties. This podcast was recorded on July 12th, 2024.
Let's go straight to the discussion of U.S. rates, ultimately having a huge impact, potentially, on emerging markets. Why are we putting the two together?
Sure. Yeah. So the strong dollar has been a headwind for emerging markets for a while, and they've been stop and go over time, where the dollar weakens a little bit, and you see the EM flows into EM and EM markets kind of start doing well. One of the reasons is that when the dollar is strong and the rates are high here, the central banks around the world, especially in EM and places like Brazil, Mexico, you name it, tend to keep their rates high and try to protect their currencies. Now, they've done a great job this time around. They did increase their rates, in fact, sooner than the Fed moved. And they've stayed up there. They've started cutting a little bit, but have taken a pause because, as we know, the policy here in the US has been a little bit of a, wait and see approach. The expectations were different like 6 months ago, where they are today. But net, you're still going in that general direction. So the moment you start seeing, as you said, some weakness in inflation, some weakness in the dollar, you start seeing asset classes like smaller cap companies and emerging markets getting that tailwind. And I would suspect that when that happens, you're going to see the benefit of being diversified and invested in emerging markets as well.
Okay, fascinating. Okay, we're gonna dive right in there. Just one more piece of that ultimately. So various emerging markets, you mentioned a couple of them there, have kept interest rates high because they don't want their currency to fall, and also it's sort of in line with what the Fed is doing. Are they actually, some of these markets that have high rates, are they actually fighting inflation? I mean, are they in need of high rates to fight inflation? It's a problem for them right now?
Well, that's the interesting part, and the answer is no. So the inflation rates are quite in check in places that aren't keeping the rates high. It's mostly the story around currency, to a lesser extent, US dollar denominated debt that companies or governments might have. That's not as big an issue. That was a bigger issue, I would say, like a decade ago. But it's mostly about trying to keep the currency stable. So, the inflation doesn't come. But it's more anticipatory as opposed to, fighting inflation, which is what we're seeing the Fed do here in the US. Brazil is a great example. The real rates there, which is basically the difference between the rates and the inflation rate, is very high. So that number basically tells the consumer there is you can sit at home, put your money in the bank, and you're beating inflation by like 5, 10%. I mean, who wouldn't want that?
Right.
But that's not sustainable over time. And when you go in the other direction, you're going to see like a tailwind come from that as well, where investors and more local investors, companies, etc., are going to have more capital, more opportunity to invest it in the real economy, as opposed to sitting in cash and just enjoying that high rate.
Right. So interesting. So, I mean, here we talk about a rate cut influencing sectors that are interest rate sensitive. Also in the cap size, like small caps in theory should be a
Yeah.
winner and fly. And we're seeing some of that. So emerging markets fit in that as well.
I would say that, yes.
Yeah. A cut should make them do something good. Anyway, I won't say fly, but it should be a real catalyst ultimately.
That's the expectation, yes.
That's the
Sorry.
expectation. So let's dive into biggest emerging markets. It's often something that you or Sam have discussed. The fund is great because it allows you to move within various different markets depending on when they're overly expensive or less expensive. Your general style is GARP, which we can talk about more later. But you just want to think of India and China. China is cheap, India is absolutely not.
Yeah, well, that's a great place to start because it is a little bit contrarian in terms of the way we have been positioned in the fund over the last year and a half or so. And we have been increasingly becoming more and more underweight India, which has gone from like 12, 13% of the benchmark to all the way to 20% of the benchmark. And China has gone in the other direction. China is around 25%. So India has actually become pretty sizable, as a second larger country within the EM universe. The valuation has gone up a lot. Companies that were like 20 times, 30 times have gone to like 50, 60 times. I wouldn't call it a bubble, but it does feel a little bit like that people are chasing, the equity market in India. And in China is kind of the flip side where, everything is the sentiment is rock bottom. Economic expectations are really kind of very, very tough. Like, see in our peer universe, a lot of people are underweight China by a lot. We, on the other hand, have been adding there because we see that bottoming happening. We're seeing that in earnings. We're seeing that in economic data. And you want to position in advance of that. And the government is becoming incrementally more supportive. They want more employment. They want their companies to kind of feel more comfortable about the regulatory environment. Messaging is there. Activities are there. Stimulus has been somewhat sporadic, I would say, in coming from the Chinese government, but they are kind of moving in that direction. So I would say, like, it represents really good companies at extremely inexpensive valuations, and we find that very attractive. So, as you mentioned, growth at a reasonable price. It's a balancing act. We want that growth exposure, but we want to be making sure that we don't overpay for it.
Um, I mean, one of the big questions about investing in China has to do with geopolitics. How much of that is, maybe that's already priced in, so it's okay, but yeah, how much of it is it priced in?
Yeah. Well, it's always kind of like part of the story in terms of the discount that you might end up having for companies in China that are competing with global players. Very similar technology, very similar type of companies, but they do trade at a discount. And some of that does come from, the regulatory environment that can be at times a little bit less, dependable and consistent. And there is obviously the geopolitics. Geopolitics tends to have more of an impact on certain sectors and certain parts of the economy. We tend to focus a lot more on the consumer side of things, communication services, domestic stories in China, less so in areas where you do have that kind of potential for conflict, potential for sanctions, and so on. So we've been cautious in that regard for a while now. The big question is around Taiwan and China, the status quo. Does it stay the same? Anything changes? Our view is more on the status quo side. Nothing changes dramatically. Partly because of the lessons from like Russia, Ukraine, and how that's unfolded over time for Russia, and partly because China is more of a country that focuses on social stability. They don't want to do anything that would harm that or dislodge that. So that keeps us, I guess, comfortable that these companies look very attractive at where they are and represent an opportunity. Longer term, there may be challenges, 5-year, 10-year time horizon, but at least like 2 to 3 year time horizon, they look very attractive.
Fascinating. So interesting. So we'll come back to regions and countries in just a minute, but I just want to go through some of the themes. What you've mentioned there, so you're focusing on the consumer, you've mentioned a couple of themes there. What about either sector? Let's go into some of the sectors. So go into perhaps energy. Also defense, I wanted to ask you about in light of NATO. It seems like every country is spending more. Same in emerging markets?
Definitely. That's true. There is instability in the Middle East, concerns in Asia. One of the companies that we bought in 2022, after the war started in Ukraine, was a aerospace company out of Korea. And they make trainer jets. They make jets for, Lockheed Martin trainer jets. So you practice and train in those jets. Their market was very small pre-war, mostly Korea and maybe some countries nearby. That's it. And that's exploded in terms of investment opportunity for them. their order book has grown to include countries from Middle East, from Eastern Europe. In fact, they're competing for an order out of the US. So you can see that all of a sudden a sleepy company, very localized company, has a great runway for them in terms of growth opportunity. Similarly, a company in India that made dynamite, dynamite mostly for uh, mining and those types of operations, but defense component of it is also growing against very considerably now. So that's two examples of that. Um, Other sectors, I think, while I did say we are underweight India, but we still like the long-term infrastructure story in India. So we continue to stay invested there. So companies that make highways, bridges, ports, and things like that. Even though they went through an election recently, the expectation is that the investment profile over time from the government in these areas is going to continue. So we continue to stay invested.
Continue to stay invested, and you've had those types of exposures for some time?
Yep.
No.
Yes. In India, yeah, for a while, for a while, and they're going to stay there for a while. It's just that those companies became very expensive, so
Right.
maybe we've taken the bet size down, but the underlying story is still definitely intact.
Fantastic. Let's shift to, we'll go sort of between some of the sectors. So you've hit consumer, you've hit defense. Anything to update on certain other regions, the energy story?
Yeah, so energy is relatively small sector in emerging markets because obviously the Russian energy companies are pushed out of the out of the universe. So relatively small. We did finally added a position in Middle East. So that's one thing that we've talked about over the last few years. Middle East has become a bigger part of the benchmark as Russia exited. A lot of that demand for energy names and things like that went to Middle East. Saudi Arabia became a big part of the benchmark. So we recently added a position there that we feel like fits with our process and philosophy. A lot of ideas were doing very well there, but they were very expensive. So in this case, we bought a position there. We've also added some exposure to Eastern Europe, financials exposure in Poland. We still maintain our position in Greece, again a financials exposure. Some of them are more self-help stories, but then also these types of companies are going to be participating in hopefully a rebuild when we get to the other side of the war. So the net being closer there makes sense to buy some exposure in that area.
That's so interesting. Fascinating. You mentioned off the top that a number of emerging markets, Canada also does this, lots of countries do this, any country issues in US denominated debt, they'll issue debt in US dollars. Just tell us a little bit about that component, what it means, and actually if it's what kind of obstacle it could be, or what sort of tailwind it could provide. But how much of a piece of a story is that US denominated debt in emerging markets?
So it's much smaller. So that was one of the lessons that countries and companies have learned over years, like try to have your debt in like the local currency, because if you can create a market there, your liabilities and assets are in the same currency, so you don't need to worry about currency movements. So it's not as big an issue anymore, but it's kind of like it's more of the history where companies in Brazil in particular got into trouble because of that, and so everybody's kind of a lot more cautious there. So I would say like it's more like localized debt now as opposed to having debt in US dollar, with the exception of maybe some companies that are operating in a global environment, right? If you're an energy company, you are competing around the world, and again, your assets and liabilities can be in like various currencies. It makes sense to have maybe some debt in USD, but it's not a huge part of the concern or story, but it is definitely like a part of the I guess like I'm looking for the word like
Part of the picture.
PTSD kind of thing
Yeah.
from the past, right?
So it's good to hear that that's gone down, as sort of a relative story that's lesser. So let's go to Latin America. Latin America is an area that I know you, Sam, have spoken about in the past. You mentioned Brazil there, and sort of in terms of the debt story. But there are lots of things to like, as I recall, about some of the countries in Latin America. Why don't you take us through some of
Sure.
those and the sectors
Yeah.
that they fall into?
So so some of the names or areas that we are invested in, Latin America tends to be quite intense on the natural resources, whether it's the energy sector or in mining sector, a Chilean mining company that we've had for a while. That's a copper mining play. And then Brazil as an economy has a lot of pent-up demand, as I was referring to earlier. The consumer hasn't done a whole lot. There's a whole lot of need for infrastructure development and other things that are kind of on the back burner. But as the rates come down, you're going to see like more activity happen in that direction. The fintech space in Brazil is doing a lot of innovation there. We don't necessarily have a specific exposure there, but that kind of tells you that innovation and other things are happening on the ground that are interesting over time. Mexico story is a lot more closer to home. I mean, they do depend a lot on like the U.S. activity and demand in the U.S. Cross-border, um, trade and so on. So that is kind of joined at the hip in terms of what happens in the U.S. in certain ways. Uh, they did have an election. I think it went too far in one direction, and you've seen the volatility in the market and the peso because of that. Concerns about like what might be the policies that might come out. So that creates a little bit of I would say like a caution in the near term for that specific country, but it's still like a long-term story.
So give us a little. You've broken out some broad themes, the different stories, and the currency, and sort of the big story of rates, and then individual countries. Give us a sense of the allocation right now. How are you positioned? Is which countries to an extent are either neutral, or where have you got more?
So our big overweights are in China. As I mentioned, the valuation story is very attractive. The companies are kind of becoming net incrementally positive in their outlook. Um, we do like Brazil to a certain extent, overweight there as well. But the big thing on the country level is like India being quite a sizable underweight. And that's, within our parameters, we do have some guardrails in the portfolio around sector and country weights. Sectors are plus minus 5%, countries are plus minus 10%. So even as I say, like it's a big underweight, it's still within that plus minus 10%. And as I said, India is about 20% of the benchmark. So those are like the big positions. On a sector basis, we still like material sector. We were overweight there, kind of expecting more of a cyclical tailwind for a number of underlying commodities. But then also overweight consumer communication services. Where we are a little bit more cautious at a sector level is information technology, mostly because those stocks have run up a lot. Like, so the AI story, which you kind of mentioned in the early part of the conversation, like the Magnificent Seven in the US and so on, that has had an impact in emerging markets as well. So valuations in that or adjacent names have gone up there as well. In fact, TSMC today is almost 10% of the emerging market benchmark. It wasn't that big, just 5 years ago. So you have to be cautious there because again, the valuations have gone up a lot, especially in Taiwan's tech space, where you do have like maybe not necessarily direct beneficiaries of this build out of AI infrastructure, but they're being valued like that. Companies are going up faster than Nvidia in the US, and the business is not really changing that much in terms of margin growth or earnings potential and so on. So got to be cautious there. We're cautious in information technology area in the
Fascinating to hear that. It's that kind of story. For a long time, we've been hearing so much on India, but its allocation remains low in most EM funds. Maybe you've answered this, but the question is why?
Yeah. So India is, for us, it's a great long-term story. So it's a country that is going through a lot of change, putting a lot of investment into infrastructure, trying to become a alternative for supply chains, global supply chains. You've seen Apple kind of incrementally making more and more phones in India, like assembly of them. But there's a huge opportunity for them to keep building that infrastructure, to take the goods from the factories to the ports, from ports out in terms of exports. So the story is intact. It's just a question of valuation in terms of like where it stands today, and that's what keeps us a little bit more careful in the short run. It has gone up a lot. So, and then the story of China is totally kind of the flip side of it. It's more of like the valuations look very attractive. Granted, all the risks are everywhere. No exception. China is no exception. But looking at the quality of the companies, looking at the earnings potential for them to recover, looking for their re-rating to happen if things start kind of becoming more positive from a sentiment perspective, all in all makes us more positive there. But India, as I said, almost 20% of the benchmark. It's gone up like a rocket. So you got to be careful.
I mean, that just makes me want to ask the question, is there a bit of hot money in there, do you think? Like, is that we ask that about the Mag 7 too sometimes.
Yeah.
But
I think in certain parts, like the mid-cap space in India, feels a little bit like that, where even the domestic investors are paying a lot more in the stock market. In fact, banks are telling us that they're having a tough time attracting, deposits, even though they're giving like, the fixed deposit in India would give you like 6-7%, which is higher than the inflation rate by 2%. People are not doing that because they want to much rather speculate or invest in the stock market because it's been going up, and that's normal. That's what you expect when we've been through multiple cycles like that in the U.S. From the dot-com era to maybe some people might argue we're going through something similar here in the AI space, but India is kind of feeling that as well. So yeah, so that also adds to the caution.
okay, it adds to the caution. How much of a game changer, or even a bit of a brave new world, is it that many of the emerging markets that you're interested in investing in don't have inflation problems? I mean, that was always the story, no?
Yeah, I mean that's mostly because they moved early, right? So they anticipated. So that in a way, that's a good thing because they've learned from the past experience, moved early to raise rates more quickly than the Fed, and that's kind of helped them over the long run. The other thing is like, I mean, there are some exceptions like Turkey and all, which are kind of a little bit a tougher place to be, but we're not exposed there. But in general, that's been part of the reason why they've been able to navigate this much better than in the past.
Abhi, where does this fund fit for investors? Do you think you're obviously, you're speaking to Canadian investors making Canadian bucks? It's nice to be
Yeah.
invested sometimes for currencies like the US. But this is a different story. How does this fit in, do you think?
I think it's a diversification story. I mean, there's like I can't tell you that the next you can look back and figure out like what might happen in the future, but it's hard to do that.
Yeah.
So if you look at over the long term, there are periods where EM does really well relative to developed markets and US, and there are periods which we've been through where it doesn't do as well and kind of gets left behind in terms of performance. And it's a cycle, right? So I don't know when that turns, how that turns, but it will turn at some point. Maybe that trigger is like the Fed policy, and that becomes more consistent over time in terms of a tailwind for flows into EM and interest in EM. If you look at our funds in general, they have been in net inflows because a lot of the asset allocation people are making those calls now, right? It's always late to kind of change after things have moved. So I would say like people are becoming incrementally more cautious on US and moving more on the international developed market and emerging markets as a rebalance of their portfolios.
Come back to GARP for us. I mean, it goes to the story of how you're invested in China versus India or India versus China, back and forth. But what fits that for you? I think a lot of people are familiar with the investment style, but maybe give us an example of a company that you can share with us that illustrates growth.
Well, I would say like, yeah, so TSMC, which is like, as everybody knows, it's a big part of the benchmark. We have a small position there, overweight position slightly, but it's mostly, that's a great example of a company that's growing, but the valuation still looks quite attractive on a relative basis, right? So that gives you a feel for that. Samsung is another one. That's a company that is doing well, I would say it is a more complicated business. It has have like other parts as well. It's got the memory play, it's got other things, phones and semiconductor manufacturing, all that stuff. But that also looks relatively, inexpensive and attractive for the growth, earnings growth potential that might be there in that type of name. So those kind of fall in that category of growth, but at a reasonable price. So, like that's where the regional price component brings a little bit more balance to the portfolio, so you don't become too lopsided. You don't want this fund to become like an AI fund and just all eggs in one basket. So having that balance really helps making sure that we are diversified within the fund in terms of the themes and sectors and countries and ideas that are there.
I mean, and that goes to sort of the element of protecting against risk, or just having risk at the forefront, of not overpaying in case something happens, right? I mean, in
Right.
case bit of a recessionary flavor, whatever that is, a geopolitical, an uptick of some sort. It's if you're paying low prices, you're better protected. But
You're slightly better.
go into that. Do you have to worry about that more with emerging markets, for instance?
I would say so. At least that's what Sam's philosophy is. Like he doesn't he is you could technically buy like more expensive names if you're thinking for like 5 to 10 year time horizon. It's hard to do that as an investor. So our view is more like, okay, let's look at like next 2 to 3 years as opposed to like 5 to 10 years. And then what you see there is where you kind of assess the opportunity, what's priced in, what's not priced in, how our analysis at a bottom-up basis leads to a slightly different conclusion from what the street might be saying for that individual name. All those kind of fall into that analysis of fundamental research to determine whether you like a company or not like a company at the current point.
Who have you met with recently? Have you done a lot of travel or met with companies, for instance?
We've been traveling quite a bit over the last couple of years. I think been to Middle East recently, to Greece, heading to Poland. So like a lot of different places. Brazil is interesting because Brazil tends to have a lot of conferences in New York. So we, as a team, we end up going there and meeting a lot of companies in one go. That becomes quite efficient. A group went to mainland China about a month ago. Like I would say like 4 or 5 people, some from Hong Kong office, some from here. Again, meeting a bunch of companies around the conference in Shanghai. So yeah, we're back from a travel perspective.
You're back off and on planes and back into the hotels. Great to speak with you, Abhi. Any just final thoughts for investors?
No, I would say like look at the diversification, look at the where the valuations stand on EM relative to everything else you might have in your portfolio, and try to make a judgment and a allocation based on your risk appetite.
Fantastic. Abhijeet Singh, thank you for joining us here on Fidelity Connects. Have a great weekend. Look forward to speaking to you later on.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.